Now, without further delay, let's begin today's event, WesBanco's Economic and Investment Outlook. I'd like to introduce Todd Clossin, President, Chief Executive Officer of WesBanco. Todd, the floor is now yours.
Thank you. Well, good afternoon, everyone. I'd like to welcome you all to this virtual Economic and Investment Outlook webinar today. When John Dargish, our Head of Trust and Wealth Management, and I discussed this event a few months ago, we initially thought about canceling it this year due to the pandemic, but we ultimately decided that we could expand the reach and the scale of the event by holding it virtually. So as a result, this year's event has even more attendees representing even more geographies than ever before, and we're excited to have you all with us today. At this event last year, we were just about to complete our merger with Old Line Bank in Maryland. That merger was successfully completed, and we are now one of the 10 largest banks in Maryland. We're very glad to have many participants from Maryland on the call with us today. The merger has gone very well, and we're fortunate to have completed it just prior to the start of the pandemic. We've also been very active with our customers and our communities during the pandemic. We were one of the first banks to make a pandemic-related financial commitment to our communities by donating more than $500,000 to various charities that supported those in need. Our employees also decided to take the $200,000 budget we had established for this year, which is our 150th anniversary year. We took that budget and donated that as well to local charities, and I'm sure our founders would have been proud of that decision. We provided short-term loan payment relief to more than 20% of our customers' loan balances, and that number still under payment deferral is down to only 2% at this point in time. We also made more than 7,000 PPP loans across our 6-state footprint to provide customers and a few non-customers added financial cover during this uncertain economic times. And all of this was completed with 95% of our non-branch-based employees working remotely since last March. Our new Diversity and Inclusion Council is having an impact within our bank as well as outside of it. It is creating a model that will become part of our culture for years to come. A special thanks to Board Member Steve Proctor from Maryland for his help with that council. I'd now like to introduce Scott Love, who is Senior Vice President of WesBanco and is also President of the Westmark Funds, who will be our first speaker today. Scott is one of our most talented executives. We're very pleased to have him on our team, and I'd now like to turn the floor over to him. Scott?
Thank you, Todd. 2020 has been a year of change for the Trust Department as well. That change has included adjustments to our new work environments, different ways of conducting business, and different factors in our investment decisions. Also, you've highlighted historically our investment seminar was held in Wheeling, and with restrictions in place due to COVID, we've switched that format. As a result, this will be our 49th annual investment seminar, but the first to be held virtually. It's also been a year of growth for the Trust Department, as total assets under advisement have increased to $4.8 billion, and that includes nearly $1 billion in our Westmark mutual fund family. The growth over the past couple years has come in both the form of acquisition as well as organic growth. A few years ago, we were fortunate enough to add a robust trust and investment services team in Kentucky, and we look forward to building out our team in Baltimore and D.C. markets in 2021. We would be remiss if we didn't mention our WTIS, or Trust and Investment Services teams in our legacy markets. These strong teams have been essential in allowing the department to develop into an emerging regional financial services company. This growth is one of the reasons why we are excited to be presenting today in this format, as it allows us to connect with clients and prospects across our footprint. In addition, throughout the event, we'll be able to collect questions, so feel free to use the Q&A feature as we move through the presentation. Today, we're thrilled to have Linda Duessel, Senior Equity Strategist from Federated, with us. Many of you are familiar with Linda in her dynamic presentations, as she's been a keynote speaker at a number of our previous investment seminars. Others will have seen her quotes in a number of nationally known publications or her interviews. Thank you for joining us, Linda. The call is yours.
Well, thank you very much, Scott and Todd and everybody from the WesBanco team. It is my pleasure to have the chance to talk to the group today. What a crazy year 2020 has been, and for sure I think we're all looking forward to 2021. So it is great. Maybe someday again we'll see, hopefully next year we'll see each other in person, but so grateful that you dialed in today and to listen to Federated Hermes Economic and Market Outlook. And as the title of my presentation suggests, it really does all depend on your time horizon. And I would like to, at the first, dive into the near term, the next 12 months, and what one might expect. So we are obviously in the middle of a pandemic and suffered a recession earlier this year as we and the rest of the globe really shut down our economies on purpose in the name of getting this virus under control. And we didn't obviously know what much was going on at that time, so we were asked to shelter in place. Closing down our economy put us into the worst economic recession since the Great Depression, even if it was very, very short. And as we came into the third quarter of this year and now in the fourth quarter, many observers believe that we're already out of that recession. So it's been a heroic effort on many counts here to battle the situation that just really came and bit us by surprise in our country. I would like to say at this point, as I make my way through there, COVID is very important. The virus is so very important in how it plays out insofar as what happens in the next year with our economy and then what we might expect from the stock market. And this already has had some effects, and thankfully, for the most part, very, very good ones, actually. And it's difficult, whenever you have some kind of a rocky situation, something that you had never expected to come, and particularly if it's a big one, then it's very tough for us as strategists and those on Wall Street to try and figure out what it means for the economy and the markets. And there really isn't much to compare it with. We haven't had a pandemic since for over 100 years, I guess now, 100 years or so now, and we've never closed down our economy in this manner. So the one place that we could find something to compare to that was pretty serious and pretty sizable in nature was the global financial crisis. And that's this first chart that I want to share with you today, where we're looking at two bars here. And I'd like to focus in the middle area of my chart here, where we look at particularly the black bar, which is the decline in the revenues of the S&P 500 in the second quarter of this year. That was the worst of it, and compare that to the worst of it at the global financial crisis, which was actually back in the first quarter of 2000. I think we have a little typo right there. First quarter of 2009. Forgive me for that. And what you can see here, though, is that the decline that we saw this time around, as severe as what it was not nearly quite so bad as what we saw back at the time of the global financial crisis. That is very good news. And, a lot of people ask me in my travels, what's up with, my virtual travels, what is up with the stock market? We reached all-time record highs very recently here, as recently as within the last week, in both the S&P and the Dow. And a lot of areas around the globe have had great years, really. How can that be when the fundamentals look so bad out there? For if you are somebody who watches the major television stations, or if you watch CNBC or one of the financial programs, whenever they go to break and they show a picture of Times Square, for example, and you see how very few cars are on the road, how very few people are walking around. We see in our own cities, there's no traffic out there, and it just feels really bad, really very, very bad. People say, how can this be that the stock market could do so well? And the thing about the stock market is that the stock market at any given moment is a reflection of what we think will happen in the future. It's a reflection not of what we know today, but of what we think will happen in the next 6 to 9 months. And if you believed that this was a temporary situation, which is actually something I've been insisting as I've done many of these meetings over these last months. It's just temporary. Come on, please, it's just temporary, as we tried to tell people also when the market was having its nasty decline earlier this year. You can look through that. You can look over the valley, as we say, because the market is a forecasting mechanism, and it is forecasting good news. When you look at the breakdown of what was responsible for the big hit to earnings of the S&P 500 in the second quarter of this year, the worst quarter, well, 3/4 of it was directly attributable to the pandemic. And we know what those were. Those were travel-related, energy, and anything that might use energy got hit, particularly transportation, airlines, other travel-related, and, of course, bank loan loss provisioning. And I know that Todd and Scott are very well aware of this, where banks, many banks out there they've lent to businesses, some very small businesses, and many of these businesses, particularly the smaller ones, they ran through their PPP. They didn't even know at that time how long they would last, or now can they make it through until they can get another form of stimulus. And banks have to provide for that loss when they see that it is quite a possibility. Now, if things go particularly well in 2021, and we at Federated Hermes are bullish about 2021, then quite possibly banks could look at their loan loss provisions and say, actually, we didn't have the losses we thought we would. They have to reverse that. That'll be actually very good news for the bank's earnings. And since financials is really one of the bigger sectors of the S&P 500, that can be very bullish for the stock market. So the idea that the worst of it, and truly it was, the third quarter was much, much better than the second quarter was, and actually in terms of a turnaround in earnings and revenues and earnings was much better than Wall Street analysts had thought. So this is good news. This is good news, but that's not all. That's not all. When we look here at profit margins, look at the profit margins of corporate America. And I just thought this was really spectacular. We go all the way back to 1952, as you can see on the chart, goes all the way back to 1952. We try to look back as far as we can in our work as good students of history. And the line that we show you here are profit margins in the S&P 500. Indeed, at the end of last year, corporate profit margins reached an all-time record high. Yes, they were hit very hard here in the first and particularly the second quarter of this year. And that has begun to turn itself around. But as bad as that was, that level of profit margin with the worst recession since the Great Depression, even if short, was a higher profit margin than at the peak of any prior business cycle. That is how superbly strong is corporate America. And I like to say, if I had to live through a pandemic like this in any country, I'm glad to be doing it in the United States, both as a citizen but also as an investor. Because when you look at the strength of both businesses and consumers here in the black mountain and then businesses in the gray shaded mountain, look at the strength of their cash flow. Their free cash flow is as high as it has ever been. And here we go again back to the early 1950s. So I find this is very, very interesting. We know that businesses have been very, very frugal. We know that consumers have too. And, in general, we would keep cash flow. We as consumers, we like to spend our money. We like to go shopping. I know I'm not the only one who does. We love to go shopping, and generally we'll keep, maybe single digits, low single digits, mid to low single digits of our income, and we may keep that back. But then look at this down here. Look at this line down here of the black bar, and that's consumers actually going negative in their free cash flow. That is a pretty euphoric consumer who just went out and borrowed and bought everything. And that's what we do historically. We go shopping. But when we had the global financial crisis, which arguably is worse than what we're suffering now, which is more of a natural disaster than a financial one, people were really scared, not just businesses, but consumers, individuals as well. And, as someone who used to travel pretty much every week on behalf of the company, I've been to all 50 states in the land in these last, say, 12, 15 years. I can tell you firsthand that I've met many, many people in our country, many fellow Americans, who never relaxed, even as our economy came back, beginning in 2009. They were always looking for something bad to happen, and consequently, just saved a lot of money. Look at all the money we saved. Look at how big that mountain is. And in fact, when we got the $1,200, remember the $1,200 that many households received in the form of stimulus earlier this year by our government, much of that was saved, so that at the moment, a record 12% of the entire GDP, the entire size of our economy, is in free cash. So for the most of us, for the most part, most consumers and many, many businesses, indeed some small ones not at all so much, and some of the lower income cohort not as well, but indeed many of us had the wherewithal to make it through those tough summer months as we got more of our jobs back. And that's good news, but there's even more good news, and that is a truly breathtaking and unprecedented stimulus. And what we're looking at here is stimulus from that was received by the United States, people of the United States, but also around the world, in terms of the central bank liquidity, as well as what we call fiscal stimulus, which is monies, stimulus and monies that have been given to us as citizens or as businesses from our central government. That would go directly to the payroll protection program for small businesses, those monies that were directly given to small businesses, as well as the extra bonus checks that I mentioned already, the extra $600 that was received by people who don't, forgive me, I got distracted there for a minute, by people who don't have their jobs back. All this money's together represented 44% of the size of our economy, and that is really heroic. Good news is they did it around the rest of the world. Interestingly, the second largest economy in the world, that being China, didn't do nearly so much as the rest of the globe did. They did much more of a draconian shutdown, and in opening up, they've had the first opening, and they're having a kind of a V-shaped economic recovery as a result. You know, all this money printing brings up questions out there. I see if I pause and see if anyone does have a question about all this money printing.
Yeah, Linda, I think that's one of the questions that people were looking at with cash and stimulus dollars kind of floating out there. I mean, do you see inflation becoming an issue in 2021, or kind of what's your view on inflation in the upcoming years?
Yes, well, thank you, and thank you very much for that question. It's actually a big, big concern that we hear voiced a lot, maybe more than any other concern, in terms of the notions of how can this possibly be? It just doesn't feel right, does it? That money could be printed from out of nowhere, which it certainly has done, and that this can end up well or not end up in a big inflationary situation. And I will make two comments about this. The first one being, in terms of printing money out of nowhere, it is unprecedented, this amount of stimulus. We're talking about trillions of dollars here in the United States alone, but also trillions around the world, printed and pushed out into our society, and people wondering whether or not all those trillions of dollars can lead to inflation. You have never had this before. You never threw around trillions of dollars like this, even as recently as a year ago. And of course, now they're talking about a phase 4, that if we don't get it, we know we're going to get a big stimulus again next year. All this money printing. What about the debt? And we'll discuss that down the slide deck here. But also, what about inflation? Well, inflation can come from two ways. One is by crushing the value of the currency. Now, We don't see the United States currency getting crushed, not at all, not at the moment. In fact, we've been a very strong currency, and all is well. But you notice here that the size of our stimulus is actually matched by many countries around the world. It is only if we do outsized stimulus that I'm going to start to worry about the value of the U.S. dollar, which would bring inflation. And that will be something to watch closely as we go into next year, particularly if we get a Democratic sweep and we get another big stimulus bill. I know they're talking about a lesser number right now, but I've seen the numbers as high as an additional $3 trillion. If this percentage of GDP in terms of stimulus gets outsized versus the rest of the globe, that could give us inflation by way of a weaker dollar, and I personally will be watching the dollar very closely. So far, so good. But the other reason that we don't see the sort of inflation you might see would be the other reason how you get it, which is too many dollars chasing after too few goods. And that's what actually my next chart shows here, which looks at the Fed balance sheet. This is our Federal Reserve saying, all right, we're going to print a lot of money. It is at the ready. Go out there. Go ahead. Borrow that money. Spend that money that we have made it easily available to you. But as long as the velocity of money comes down, and it's actually at a record low, which is to say, as long as we don't go out and borrow that money, as long as we're hoarding cash, which is what we continue to do as businesses and consumers, then you're not going to have too many dollars chasing after too few goods. Quite the contrary. We're starting to see some other evidences that it's starting to maybe begin to turn itself around. But we really need to see this turn itself around. We need our economy to get going again. We need the economy to open up, importantly, but we also need confidence. And I think that the confidence is going to come depending upon when the virus decides, the virus and the vaccines. And we at Federated Hermes believe that you will see vaccines come and get to the vast majority of us by the middle of next year. We're obviously bullish about the implications of that. There's a lot of pent-up money out there that wants to be spent. So we can start to look for inflation, but truly not just the Federal Reserve, which looks for a nice low positive inflation rate of about 2%. That's what the globe generally does look for. We've been unable to get that pretty much all around the world. So that's something that we still are waiting for. Not worried about an inflationary problem yet, actually quite the opposite at the moment. But here's actually very, very good news. And this is a chart, and I will apologize to you. We get this chart monthly. I guess I should apologize for the size of the print as well. But it's not so important, the names of the countries within. This is information as of August, and I have new information. We get this monthly that didn't make it in time, and I apologize for that. But I do want to make mention that we are very much interested in how the global economy recovers from this. And we're seeing good evidence of a synchronized global economy where a vast majority of the world is doing much better. What this chart looks at is the manufacturing sectors of various economies around the world. And are they in growth mode or in contraction mode? Are they out of a recession? And you want to be above this line of demarcation on the x-axis, and you can see the vast majority of them are. This is a piece of information we get every month, and we want to see the number each month look better than the previous month, strengthening and not weakening versus the previous month. You want lots of countries in this upper right quadrant. You can see China here. Here's the United States right here. Lots of Europe has been here. If I had the updated chart to show you, and I'm sorry that I didn't make it in time, what you would see is we are still all in expansion mode, still good, but more recently we've moved weakening month over month as we've suffered, as we all know. We've suffered around the world a second wave, and good news what we're seeing in terms of the second wave, that Europe seems like it's peaking out and starting to roll over, and maybe the United States, which has been several weeks behind, will do the same. China remains here in the strength category, and so that's a good piece of news. But we believe that you will see in 2021 again a synchronous global economic recovery, and so we'll stay tuned for that. That's good news. Not only that, inventories have to be rebuilt. Here's a chart that looks at in the in the darker shade here, the burgundy-looking shade, it looks at the growth of the GDP, the growth of our country. You can see how it has come down here, and in terms of what parts of what contributions there are to the growth of our country in terms of business surveys, manufacturing, and inventories. This specifically here, this lighter shade shows you specifically with inventories. These two lines generally dovetail. When an economy is doing well, then companies will buy it. Well, they'll buy their inventories. They'll rebuild their inventories. And this time around, they've been loath to rebuild their inventories because they don't know about a second wave. They don't know if it's, how bad it could be. Will we shut down our economy again? And so they've been dragging their heels, and you can't just keep doing that. Eventually, these two lines meet. And if you agree with us that the economy does look like it is in recovery mode, we think we should do much better next year, even though we may likely see fits and starts, given the size of our country and the different rules being made by different states around our country. We still think you'll see it come back up, and we think you'll see the need to rebuild inventories, and that will be great news for any area of our economy that services inventory build, and that will be a nice tailwind for us. So we look at businesses. We dive right quickly here into businesses and show how frugal they've been. Here I'm looking at cash flow that companies have as versus their capital expenditures. And, capital expenditures, those are big-ticket items. For us, it would be, an automobile or a washer and drying machine, these big-ticket items. For businesses, many businesses have been starving their capital expenditures. And what we can see here is, with the red lines and the circles, is historically, here I'm going back to the mid-1990s, and cash flow generally is drawn down when an economy is doing well. Businesses feel good. They feel like they can spend, like we feel we could go shopping. And so their cash flow starts to go down as versus capital expenditures. Then when they fall into recession, which is what the circles represent, then they just batten down the hatches and they decide no more spending on capital expenditures, and they build their cash flow. So here was one cycle, very natural behavior. Things get better. They start to spend money back here. Then we had the global financial crisis and the housing bubble bursting in 2007 and 2008. Terrible recession, built up that cash flow. And as I suggested to you earlier, lots of people were shell-shocked by that housing bubble bursting and the financial crisis. And they've been very, very frugal ever since. This is businesses doing the same. Yeah, they may have drawn down some of their cash flow, but nowhere near like they had in previous times. And in fact, they've been rebuilding cash flow here. This is a rebuild that started to happen when we got into the trade war tensions back in 2018, 2019. So that when we entered this recession in 2020, we had a lot of cash flow, did businesses, a nice cushion to spend on capital expenditures if they need to. And if you think about the results of our election, this is not a political presentation at all, but if we do in the end get a Democratic sweep and you get those big tax hikes that President-elect Biden has told us he'd give us the biggest tax hike since 1968 in a Democratic sweep that could potentially occur, then many companies might decide to take that moment. They've already been given fair warning to lift capital expenditures in a way to shield their own taxes, and that will be an area of spending that could help a lot of the industrial sectors of our economy in terms of capital spending on technology will help them too. So these are some tailwinds for our economy as we go into next year. Here's consumers, same thing, only we as consumers. Here, as I said to you earlier, we like to spend money. We don't save but maybe 5%, and this goes back to 98, but truly for many years, and we go back in time here, we wouldn't hit. You can see us not saving that much even when a recession hit. But we were rocked in 2007 and 2008, and we started to ever so slowly lift our savings rate say in and around 8% or so, which is historically reasonably high. And then we entered the recession, this terrible recession. Of course, the economy slowed down, but our savings rate just went crazy. It went very, very high at that point in time. And even as we've started to spend some money again, I think we're in the high teens in terms of a savings rate. That's not like us. That is not natural. And once again, if we get the sort of confidence we need back, that would be great, great news insofar as spending, confidence, and a growing economy in 2021 and going forward. Now I'd like to dive into the COVID as it relates to the spending and our own perceptions as Americans as we look and see what areas of our economy really got hit by COVID. How it can make common sense that our economy can actually be doing better than we may think, given the shutdown and the rolling shutdowns that still remain. Hopefully you can see these figures reasonably well. It looks at the consumer wallet. You know, the United States of America is a consumer-led nation where mostly consumer spending is the biggest part of our economy. We spend about $17 trillion. That's our consumer wallet. And this area here on the left side of my chart shows you in what areas we do our spending. The big ones, of course, being housing, transportation, food, but you also see insurance, et cetera, all the way down the line. And then on the right-hand side, what we're doing is we're isolating those areas of our economy that were hit by social distancing. And we all know which ones those were. In terms of housing, the hotel and travel, the leisure industry, there's your airlines, cruises just completely shut down. Restaurants, sports, concerts. I mean, I'll give a little hello out there to the Pittsburgh Steelers. I'm a Pittsburgh lady. I realized we lost the other day, but you know we went 11-0. Like I don't suppose we've ever got 11-0, and there was nobody in the stands to cheer them on, and it just feels terrible. We can't go to the movies, we can't go to concerts, but truly, when we break it down, the amount of money that we spend annually on these areas that got hit by social distance spending is only 17 billion of the entire 17 trillion. That is 4% of the entire amount of spending is related. And of that 4%, fully 63 are restaurants and eating out. That is the area of our economy that really, really got hit hard. I think I'll pause here, Scott, and see if there are any questions at this point.
Thanks, Linda. And I think that slide's probably good for us to kind of land on. And I guess when we think about kind of the COVID cases spiking or increasing kind of across the U.S. now, I mean, is this a guide that we should use when we think about what a potential lockdown or decline might be in the economy should we see something widespread like we saw in March of April of 2020?
Yes, I think it will be exactly that. Only in very small occasions that we can think of have any of these areas that were hit, even in a shock situation, been able to come up with something that could be long lasting that can help us. So for example, the airlines, for example, have done everything to explain to us that the air we breathe on an airplane is better than any air that we could breathe anywhere, basically. And that's good. That's something that they can offer now. But I don't know that we'd be using the airlines if we get shut down again. And of course the restaurants, these small businesses, and they rely on people I know personally in my area of the globe, my area of the country. Perhaps some of you do too. Some of the establishments that we might have gone in for shopping have become very, very creative with the help of technology in terms of reaching out. I know that's the case for a number of the restaurants in our area that maybe haven't even missed a beat. They were first on to go at this. But in terms of sports, I mean, we're getting much more used to sports. What do you see? It's kind of sad to see the stick figures, instead of the people in the stand. But they're finding ways. I think if we did another lockdown for a longer period of time, there might be more discussion in terms of how people get paid, or who pays the rent, et cetera, in some of these areas. And that is a place that could lead to new concerns, but we're all kind of working on the assumption that this is temporary and we won't do a full lockdown again, so we'll see. Moving along now here to earnings. I mean, we as stock market investors need to concern ourselves with corporate earnings. And it's not about this year's earnings, it's about future earnings, next year's earnings. The market forecast bids itself up this way. And what should we expect? So here, I'm letting history be my guide again. And I am looking at corporate earnings. It's what it's all about. When you go from a peak in corporate earnings, which we peaked out at the end of 2019 in corporate earnings, to its trough in a recession, earnings declines can be bigger or smaller. That's what you can see here in these lines. It was horrible at the time of the Great Depression. And however many months it takes to get from peak earnings to the trough before you recover varies. But what is most interesting in all these recessions that we've had in our history, including the global financial crisis that ended in the middle of 2009, is it's not exactly the same, but in terms of however many months it took to reach the bottom of earnings in a trough, is give or take about how long it takes to recover. So if you look at the global financial crisis, it took 23 months to go from peak to trough. And finally, we could start to recover in that recovery 27 months. So close, not exactly, but close. And here on the right portion of my slide, you can see, that there is a reasonably tight correlation amongst all of these over time. However many months it took peak to low is about how long to get back in economic recovery. And we clearly, with the third quarter results in mind, have already seen the low in terms of the earnings trough. Things are starting to turn themselves around. So we are trying to figure out what's to expect next year. And Wall Street analysts are busy doing that too. I love this chart, and I wish to emphasize this to the group for how many times in my many years in this business I travel and talk to investor groups, and mostly we're bullish. Mostly you should be bullish because the economy is mostly growing and stocks usually go up mostly. But how many times have people said to me, "Why would you tell us to buy stocks when you know that the stock market's at record highs?" And it makes a lot of record highs to get to the most recent one, which is just within the last week. I'll tell you why. Because corporate America continues to grow their earnings. This is so powerful. Look at corporate America's earnings back in the 1970s, early 1970s, and how fabulously they have grown. That is the spectacular corporate America and the America that we live in. Here we were in 2019. We reached all-time record highs in S&P 500 earnings per share, and then we got hit hard this year. Wall Street analysts are expecting that we'll make up that loss by the end of next year. So give or take, we lost a year or two, if you will, to get back what we have lost. Fair enough. But, it might actually be better than that. And I would suggest to you that based on the strength of third quarter earnings, which were already in the books, and we have seen much better results than feared, if negative still on a year-over-year basis, much better, that this can continue to occur. And again, the virus will tell us what's going to happen, but with our ability to understand and deal with the virus, and with the opening of our country up again, it looks like maybe, very likely, this could be an undersell. We could actually do even better than that. There's very good chances for that. We feel that way for what we've already seen, but also a potentially falling dollar. It doesn't sound like we'd be rooting for a falling dollar, but the dollar coming down historically is actually a good thing. You don't want too weak a dollar. You want too strong a dollar, but historically, a bit of a weakening dollar, particularly after the strength we've seen, is a bullish thing, and I'll tell you why. Because fully half of the sales of the S&P 500 companies, of companies headquartered in America, fully half of their sales are to customers outside of the United States. And so so if our dollar gets too strong, then the goods and services that they might like to sell to people outside the U.S. looks expensive to them because they have to come up with more of their currency to buy whatever we sell. You don't want too strong of a currency. And this is what this chart shows. Now, this would go back to the mid-1990s, and it shows you in the blue line on an inverted basis on the right-hand side of this chart, which is to say the dollar, the value of the United States dollar in the blue line as compared to other currencies around the world. If you see the line going up, that is a weakening dollar, and if you see the line coming down, that is a strengthening dollar. So a weakening dollar is actually something that we would be rooting for. And what you are seeing here is that finally, after a lot of strength in the U.S. dollar in the last number of years, you're finally starting to see it weaken this year. And historically, the red dotted line, which is the forward earnings expectations for the S&P 500, dovetails. The stock market likes a bit of a weakening dollar. They like a weakening dollar, and so if this earnings number starts to move up and meet towards that dollar further, then that would be great news for corporate earnings. And particularly if the dollar continues to weaken, you can't have that divergence for too long. So that is a legitimate thing to expect as a continued weakening dollar, and especially if you believe that the United States will continue on with pretty serious stimulus. And if we do a lot more stimulus while the rest of the globe takes a back seat for that, then that is something that we may see evidence itself through the dollar, as I suggested earlier in my talk here. I'm watching the dollar. So I think I'll pause at this point and see if there are any questions at this point in my presentation.
Thanks, Linda. And I guess just to circle back on the earnings kind of slide or earnings view, I mean, there's been some concern that some of the earnings growth that we've seen has really been driven by more share repurchases, and that could be a result of changes in tax policy or even repatriation of overseas dollars. You know, do we look at this kind of adjusted net of buybacks, or what it would have been otherwise? Kind of what's the feel on that?
That's really a very cool question, and it comes up, and it does come up a lot, especially when you're making all-time record highs. The response to that is actually mixed. I mean, if corporations buy back their own shares, then they have less shares outstanding, and so their earnings per share could go up, and that's not really real and true earnings, really. And so that is a legitimate concern, and you have seen in the bull run, as you do in many bull runs, lots of companies buying back their shares. So it's a legitimate concern. But what you also see is a lot of companies giving stock options to their executives, their employee base. And some work that I have seen argues that a decent percentage of the shares that are being purchased by companies in the marketplace to reduce the number of shares are actually offset by new shares that are given in the form of compensation by way of options. So that is a mixed answer, really, so it is something to bear in mind, something that is out there, but I don't think it is as important as those who argue about it suggest. And I will just throw in one other thought for you, which is that those who look at the strength of corporate earnings and the strength of our economy in general are having a hard time with the true value of all those advancements made in technology. So that's something that may not show itself in earnings, but it is much more valuable, could go towards the price we're willing to pay for earnings. Which is to say, if I have a telephone, we all have smartphones now. If my smartphone can do many, many things that prior to I couldn't do, then it's more valuable, if you will. The advancements in technology would argue that things are actually better than what those who are trying to count things up for us would suggest. I better speed my way along, ladies and gentlemen. I see my time is getting away from me, and I want to mind all of your time. I'm looking here now at the expectation for interest rates. Many people have been worried about interest rates becoming a big problem as much as they have inflation, as there's so much debt. And here we were in March. This is our government agency, the Congressional Budget Office, trying to calculate what they think would be the interest expense by the end of this decade, interest rate that is, on average for our government debt. And they figured probably around 3% in March. Can't you believe that after all the money printing, all the borrowing that's been done, when they re-looked at this in September, they figured actually on a lower interest rate? How could that be? Is that a mistake? No, it is not a mistake. And I will emphasize that on this chart, which looks at the federal interest payments as a percentage of the size of our economy in the blue line, and then the debt in the lighter colored line. Our debt has been growing and growing and growing, you can see here, since 2010. That's got a lot to do with Medicare, Medicaid, all of us boomers that are retiring. It's very expensive, and it's adding to the debt. So that the Congressional Budget Office thought by the end of this decade, maybe 111% of debt as versus the entire size of our economy. With all that COVID borrowing, yes, much higher. But you know what? Interest expense before COVID came along was actually expected to be, by the end of this decade, more as a percentage of our economy than with all that COVID money. How could that be that more debt costs less than interest expense? And it goes to the fact that we are very likely to be living with low interest rates for a very, very long period of time. Our interest rates are low in the U.S. You can't even get 1% for a 10-year government bond. And, you think that's low? Around the world, there's $17 trillion at last count of government debt around the globe priced to a negative yield. Who would give their money to a government for 10 years and expect to get less than $1 back on the money they put in? But that's what's going on. So the notion that interest rates will stay low for a very long period of time, and exacerbated by COVID, that allows us to have all that debt. And the United States has more borrowing capacity than any central bank in the whole wide world. We have the largest, deepest, and strongest of all central banks. So I'm not worried about this, and I am not worried about our central bank, our Fed, raising interest rates anytime soon. This is their exact quote. We are not thinking about raising rates anytime soon. They used to wait until unemployment rates were down in around 5% or so, 5.5%. They might even wait longer this time. That is music to the ears of an equity investor. But in the end, it's all about jobs, and those social distancing jobs got hit hard. This is how long it takes, usually about 2.5 years, for jobs to be recovered after a recession going back to the 40s. Here is our fourth very severe recession, and we've got maybe not quite half of it back, but we're making excellent progress on that. I will argue that the second half of this is going to take a lot longer to come back. Indeed, many of those employees and their business owners that they report to who thought the closures were temporary maybe are coming to realize that theirs is a permanent situation. This is a long-term problem that we need to think about over the long term, looking closely at who gets hit mostly by social distancing. These are the top 20 industries. The average payday for those people in those industries is $35,000 a year. It is the lower income cohort that got hit the hardest. There they are, the very same areas of the country that we've been talking about getting hit very, very hard, the social distancing industries. Their income didn't get hit so badly because they got the transfer payments, and we really need that phase 4 as soon as we can for those small businesses and for those people that are still without jobs. But we may very well be dealing with a permanent job loss situation, which is already becoming an increasing problem as we've seen many jobs being taken over by machines. Here's one of our resources suggestions. Well, maybe government could hire many of these people. Surely we've lost, looks like almost 6 million jobs from the public sector since the 1970s. Maybe they could get their jobs back. This is something to talk about and think about for the long term. Probably no time here really to talk much about market structure, but what I want to say is we got lots of money here. This is the big money that came in terms of stimulus money. And interestingly, it matches very nicely with the number of Robinhood users. If you don't know Robinhood, we pretty much most of us do. That's the millennials version of Schwab, if you will. And they're buying stocks, and you're seeing a lot of day traders. That's what happens when the stock market keeps going up and up and up. That is something to concern ourselves with. And reminding me to say congratulations that you have Todd and Scott and their team, because you really need them for the structure of the market, for these crazy times that we're living in and what may be coming down the pike. Volatility could result from this. This is correlation. The correlation among stocks is at a record high. That's what it looks like when machines are doing the trading. Today, 10% or 90% of all trading is done by machines that have been programmed. So momentum trading, big time. Machines are programmed, and if something goes the wrong way, they may all decide to sell at once. That's what today's market structure looks like. Doesn't mean that stocks don't fall or rise to where fundamentals suggest they should do, but it's something to bear in mind. It could be resulting in volatility, and something that we should bear in mind. A lot's been talked about the record concentration of the 5 largest stocks. We all know them very well. They used to call them FANG. I guess Netflix lost its place to Microsoft, and there's Apple and Amazon. Last I checked, about 25% of the entire weight of the stock market was just 5 names. I don't think this is a bubble. It sure does look like one. We had one back here in 2000. Is it a bubble? And I will argue not yet, for I was there in 2000. And back in 2000, we were not looking at earnings or even sales. We were counting eyeballs back then. Right now, these top 5 companies, many big-time beneficiaries, all I suppose of the lockdown, they deserve where they are for the most part. This shows you what share they are of the market capitalization of the S&P 500. Kind of matches with their earnings share. They earn enough money to deserve where they are. If Amazon is an outlier, they're really kind of expensive versus their earnings. Not one who covers individual names. I might argue that they will earn as much as they want to when they decide to stop trying to take over other industries, which of course is what's going on. And then we said this back in September. We've seen some advancement since that time. But if the largest names, those 5 largest names, were up 60%, okay, good for them. But there are 495, actually a few more other companies in the S&P 500, many of them on sale, and I'm happy to say that we've started to see a broadening in terms of the number of stocks that have been bid up here in recognition that they're inexpensive. There's some good sales out there, and it's not easy to pick those. I'm not suggesting that anyone does, but your financial advisor they're students of this, and they can help you with this. Where should invest depends on where we are in the economy. Are we in a growth time, or are we in a risk-off time, falling into recession? We are in a recovery now. That is a great time. Some of these areas of the economy that have been left behind while we bid up a bunch of tech stocks and a few of the so-called FANG stocks are inexpensive and excellent place to potentially look. The dividend payers, okay, they may not be timely if you're thinking the market will be strong, but they are giving you an income stream that you can't get anymore by the government. So very, very excellent, actually, possibilities on both sides. I'll pass this one in the name of time and note that the love affair with bonds continues, and has been going on really since 2008, where monies were leaving stocks and going into bonds. Those are your baby boomers and very, very nervous Nellies, but they also need income. lots of money on the sidelines trumps whatever it is that you may be worried about. And now, very, very quickly getting to the end of my time, I'm so bullish about the future. The future is about the millennial generation and the Gen Zs. They're finally coming into their own now in terms of the prime age. You know, the average millennial is 30. This is when they start to surge in terms of their ability to be productive and to be good consumers. That's such great news for the long term. This is 2017. I apologize. Your average millennial is 30 now, but they won't peak out necessarily until 2038 in terms of their big spending years. And the huge Gen Zs behind them, both bigger than my generation. What a great time to be in America. So one last final one to chew on. By the end of this decade, there'll be more young people, millennials, and Gen Zs voting than the rest of the older generation. So just something to think about. Many, many thanks. Sorry to have gone on there, but it's so exciting, the times that we live in, and very thankful for the opportunity. I will now turn it back to Scott and see if there are any questions that I might be able to answer for the group. Thank you so very much.
Thanks, and there were a couple questions that kind of filtered in, so we'll make sure that we address them. But I think, Linda, the kind of overarching question is, you know, what's the outlook for equities into 2021? How do we need to think about positioning kind of client portfolios and return expectations for the upcoming year?
Well, thank you very much. The answer to that question does rest with the virus. And so if you're bullish as we are that the virus will give way to the vaccines, and it has to do with how soon we can open up and get that confidence going, get that consumer back in spending in so far as looking forward to that, as believing this can come. The stock market can continue on doing well. A low inflationary environment is bullish for stocks. The central bank has said they're on the sidelines. Stimulus coming from our government, however it is in place in Washington, D.C., is all bullish for corporate earnings and for stocks. And valuations, we would argue, are still not that expensive, not at all, though you'll be hearing and reading a lot about that. We could get maybe, you know, your average is maybe 8% returns in a year. You could get that next year. If we get it earlier than later, we could tool along sideways. So how to position? It kind of depends on who you are. Again, if you like income, you want those stodgy, more defensive areas of the marketplace that are very good on yield. They have not been looked at. Who needs to when you're having such a strong stock market recovery? And they're going to give you the yield you need. Those FANG stocks may be being sold now in the name of funding some of these more cyclical areas like financials and materials and industrials, but they're still unbelievably strong companies. So the idea of a barbell that way makes a lot of sense. Don't abandon those great companies, but look at some of these areas of the economy that will do better once we decisively get into an economic recovery. There's still many excellent ideas there. Kind of all over the map, really.
Well, Linda, thank you. Thanks for joining us on our 29th annual investment seminar. We appreciate hearing kind of your thoughts on the view of what's going on. We are now at about 3 o'clock, so we're going to go ahead and hop off. Thank you for all the questions. We're going to continue to answer them as they come in. And again, thank you all for joining us on today's call. We appreciate you being able to join us for this hour. And once again, if you have questions, feel free to shoot them in. And with that, I will turn it back over to the moderator.
Great, thank you, and thank you everyone for joining today's webinar. Kindly complete the survey that will pop up as you exit from the platform. Also, a replay of this webcast will be posted to the WesBanco website in the coming days. You may now disconnect. All speakers, please hold.